I think that everybody's kind of calmed down, both the Fed and the markets, and everybody's realized that we're probably going to have two or three cuts this year. They're likely going to start in June, if not then, almost assuredly by July. And that's going to be a tremendous tailwind for gold, but really all commodities and even equities and everything else. But in the meantime, we've got this really strange mix of buying coming into gold, really a unique mix of buying, a unique mix of factors for gold that I've never seen in my many years, even decades of history of watching this market.
Brien Lundin, editor of Jefferson Financial, observes that gold began rallying unexpectedly a few weeks ago, defying expectations of rate cuts and surprising many market participants. This rally, driven by factors unrelated to anticipated shifts in Federal Reserve policy, has prompted speculation about the precious metal's trajectory. Despite gold's volatile push above $2,400 last week, some analysts suggest that this may represent the year's high water mark. According to one research firm, markets are adjusting to the expectation that the Federal Reserve will maintain its aggressive monetary policy for longer than previously anticipated. Lundin highlights the unusual buying activity contributing to gold's ascent, including price-insensitive central bank purchases, notably from China, and domestic buying within the country. Central bank acquisitions have played a pivotal role in driving up gold prices, traditionally regarded as a haven asset during times of uncertainty. In particular, the People's Bank of China has been steadily increasing its gold reserves for over a year, with China, Poland, and Singapore leading central bank gold purchases in 2023. Lundin emphasizes that the combination of price-insensitive buying from central banks, robust demand from China, and the potential entry of Western investors suggests the possibility of a continued or even accelerated gold rally. Against geopolitical tensions, including Iran's strike on Israel, gold steadied near record highs following a surge on Monday. The escalation of tensions between the two Middle Eastern powers adds further impetus to gold's rally, which has seen it surge by a fifth since mid-February. As attention turns to the potential for a counterstrike and the risk of a full-blown war, gold's status as a haven asset remains prominent in investors' minds. Come along as we explore the valuable insights provided by Brien Lundin. Don't miss out on our latest updates. Subscribe to our channel and activate notifications. Thank you for tuning in.
Now, as we speak, 3 or 4 weeks ago, we were in kind of a holding pattern for gold. It wouldn't drop below 2,000, but it couldn't get any upward momentum either because the markets were trying to reprice in a new understanding of the Fed's timing toward rate cuts. And back then I was arguing that this is, it's kind of ridiculous that we're arguing over how many cuts or when they're going to begin. The big picture, the most important thing was that the Fed was going to go from perhaps the harshest rate hiking environment in history to rate cutting, the other side of the cycle. And during that harsh rate hiking cycle, gold had added about $400 an ounce. So it stood to do very good once the cycle turned back toward rate cuts. And that was where we were about 3 or 4 weeks ago. And it was only a matter of time, in my view, until the likelihood or the proximity of a pivot would start to have an effect on the gold price. Well, right after I was saying a lot of that about 3 or 4 weeks ago, gold just started taking off in a tear upwards. And as it turns out, none of the factors behind this big rally that we've been enjoying were the ones we were talking about 3 or 4 weeks ago, about the proximity of a pivot. I think that everybody's kind of calmed down, both the Fed and the markets, and everybody's realized that we're probably going to have two or three cuts this year. They're likely going to start in June, if not then, almost assuredly by July. And, that's going to be a tremendous tailwind for gold, but really all commodities and even equities and everything else. But in the meantime, we've got this really strange mix of buying coming into gold, really a unique mix of buying, a unique mix of factors for gold that I've never seen in my many years, even decades of history of watching this market. It's really unusual, and it is, quite compelling what we're seeing happening right now in gold. Well, historically, when the price of gold is rising, we see Asian buying slack off. Asian buyers typically and historically have been bargain hunters. They kind of support the price of gold on declines, but when the price drops, they are culturally uh, uh, prone to buy gold as a means of savings. And that's a real, obviously, there are a lot of different cultures, and it's a real generalization. But historically, you don't see buying ramping up or following the price trend upward coming from Asia. What we're seeing now is central bank buying, which is price insensitive. But we're also seeing, and a lot of that central bank buying coming from China. And we're also seeing a lot of domestic buying coming from China, even as the price of gold, at least in dollars, has broken record after record after record. The cause of that buying, the precipitating factors seem to be that the Chinese typically protect their wealth or invest in the local stock market, the local real estate market, or gold. And the real estate market and the stock market aren't are actually falling in China. So their one alternative left to preserve their purchasing power is gold, and they're actually following that price trend upward for really the first time I've ever seen it in decades of watching this market. Now,
Yeah.
what's been notable as well is that the Western investors have been absent from this. They hadn't been chasing the price higher. And we can tell that by the holdings in the GLD ETF, the biggest ETF in the West. And even as the price of gold has been rising strongly, those holdings in GLD have been falling precipitously, only to be kind of arrested. That fall was only arrested over the last week or so, and now they've started to turn up. So I think that's really important that we've had really price insensitive buying, strong buying coming from the central banks and the Chinese central bank, the PBOC, and we're seeing Chinese domestic demand. And now we're just starting to see Western demand coming in to chase this trend higher.
Global gold ETF holdings saw a significant decline, dropping by 49 tons to 3,126 tons, marking a 20% decrease from their peak of 3,915 tons in October 2020. This decline is reminiscent of a trend observed between May 2022 and February 2023, lasting 10 consecutive months. Brien Lundin suggests that the decline in the GLD ETF's holdings may have contributed to a flow of gold from the west to the east, although this theory has yet to be definitively confirmed. While the Federal Reserve's balance sheet of asset holdings reached just under $9 trillion in early 2022, it has since decreased to less than $7.5 trillion. Fed Chair Jerome Powell indicated a potential slowdown in balance sheet reduction in March, signaling a shift in monetary policy. Lundin posits that we may be witnessing the conclusion of a 4-decade trend characterized by increasingly accommodative monetary policies. He suggests that the Fed's response to future crises will likely involve even more aggressive monetary measures, which could lead to further currency depreciation and enhance gold's appeal as a hedge against such developments. Let's get back to the interview.
The competition for gold or the competition for any speculative market. I mean, we've had the gold price rise strongly, so that's would be and should be attracting speculative demand. But the that demand for gold or gold has had some real competition in terms of anything associated with artificial intelligence, crypto, the Magnificent Seven, stocks and tech stocks in general. So that's part of it. There has been some speculation as well that the holdings in GLD have not so much been sold out because of a lack of demand, but it's served as a source of the gold that's flowing from west to east and has been flowing from west to east. That's possible. I don't think we can really pin that down yet. But I think as you mentioned, I think the competition from other sectors has had a lot to do with that. But the gains have been so exceptional, and again, the Fed pivot is drawing ever closer. So I think we're starting to see that Western demand really kick in the way it has historically. My big thesis is that we are at the end of a 4-decade plus trend of ever easier money, and we're actually in the end game of that trend. There's not much more the Fed can do that it hasn't already done in crisis after crisis. And They constantly and consistently lowered interest rates over decades until they got to the great financial crisis in 2008. Then they went directly to zero and came up with quantitative easing and all these other programs, both monetary and fiscal. When COVID hit, they did all of that, but they did it to a much greater degree and much more quickly. The next crisis that comes up, and we know there is one coming up because that's just the way it happens. We've had these bubbles build up over all this period of easy and accommodating money. So the next crisis is going to happen, probably from some sector we're not really considering much. Uh, but it's going to happen. And when it does, the Fed's reaction is going to have to be what it did post-COVID, but many times more and much more quickly to get the same effect from the markets, because the markets have grown tolerant of this monetary drug, this monetary adrenaline that the Fed keeps coming up with. So as we keep going through successive crises, the currency gets cheaper and cheaper, and I think that kind of seeps into the public consciousness. What we're seeing now, in other words, is a new environment for gold. We're going to see a shifting toward tangibles, toward commodities from financials, but most importantly, we're seeing these monetary trends over decades come to a head that I think signal a new era for gold as we see currencies, not just the dollar, but fiat currencies around the world depreciated because of the enormous debt loads that had been built up over those decades. Yeah, from a timing standpoint, they really have to cut rates in the midsummer period, by July at the latest. Otherwise, they're going to appear uh, political to some degree. Their impartiality will start to be questioned. And it is a perceived to be a big issue. How will the elections impact the gold market? And I've talked a number of times to audiences and groups about this who are curious. And my basic view is that the macro picture right now will overwhelm any political influences. If you drill down and look at it, Biden and his administration, the Democrats, certainly don't seem to have any problem with spending more and more. So I think that debt situation would get greater under them. By the same token, the Republican administrations haven't shown much more restraint in debt creation, and Trump is kind of an easy money guy, a low interest rate guy. So I think that he would probably fire Powell and get somebody in who's going to be much more accommodative.
In midday U.S. trading on Monday, gold prices are weak, while silver prices are rising. Despite ongoing geopolitical tensions, particularly in the Middle East, there are indications that the Israel-Iran confrontation may not escalate further, dampening some of the safe haven buying interest in gold. What are your thoughts on the recent trends in gold and silver prices amid ongoing geopolitical tensions? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.